We want to bring in Steve Eisman. He is a senior portfolio manager at Neuberger, Berman. And Steve, there's been a lot we've been talking about this morning, just concerns and jitters after the Fed came out with a message that maybe the market's not quite prepared for. If you start thinking through that, okay, rates are going to be higher for longer, we have to figure out what that means. It's coming at a time where oil prices are up again. You've got a number of strikes taking place, wages likely to go up from here. I don't know if I'd call it a spiral, but certainly go up significantly. And Goldman Sachs yesterday coming out and saying they're looking at the biggest profits plunge since the pandemic, just in terms of what to expect from companies' earnings in the first quarter. They're going to be down sharply because margins are going to get squeezed pretty tightly. It's a lot of scary news. You can understand the red arrows this morning, but what do you think?
It's not that scary.
Okay, talk us through it.
And first of all, I'm sort of amused by people's reactions to the Fed. Every single meeting, the Fed says the rates are going to be longer for higher, and everybody doesn't believe them. And now this time they finally believe them.
Wait, I mean, longer for higher? How does that work?
Higher for longer.
Oh, okay. All right. Because people are cautiously optimistic or optimistically cautious.
They say higher for longer every time, and everybody says, we don't believe you. And finally, after the 15th time they say higher for longer, people say, okay, that's bad.
Okay, maybe they're just hitting reality, which is, if it's not higher for longer, it's going to be because a recession is starting to set in and the economy's turned down pretty significantly, and neither of those are great options.
I mean, I don't see it that way. I mean, at this point, everybody's basically been wrong about the economy. You know, people who are negative are positive, people who are positive were negative. There's no, I mean, look, there's an economist I really respect, Ed Hyman, and a few months ago, Ed went negative and said there's a recession coming. And I saw him a week or so ago, and even he admits there's no actual evidence that a recession is coming. He just thinks it's coming. So, you know,
what changed his mind?
Is there a C.J. Lawrence still around? Is that
No, he's with Evercore.
Evercore.
I mean, he just thinks rates are going to eventually cause the economy to go into recession.
But people
have been saying that for the last year and a half. So, look, I'm not an economist. This is a very humbling business. You could be right one day, you could be wrong the next, you could be right and wrong on the same day. You know, at this point, there's no evidence it's a recession is coming at all. Maybe it is, but until when? Everybody should relax.
But do they need a recession to break the back of inflation? If it doesn't,
I mean, at this point, it doesn't seem like they do.
So it'll come down.
I mean, look, like I said, I'm an economist. I'm totally data-driven. You know, at this point, inflation's coming down, the economy is strong, and people are getting hysterical because the Fed says that rates are going to be higher for longer. So I'm not so hysterical.
What do you think when you see the market? You see prices where they are. Do you see bargains in abundance?
I mean, some are starting to develop again. You know, there's been a correction. Maybe there'll be more of a correction.
You call what we've been through a correction at this point?
A little correction.
Yeah, it's pretty modest.
Maybe there'll be more. You know, tech has had something of a correction. You know, if there's a correction, at this point, since I don't see a recession companies, I'm more inclined to say they're buying opportunities and shorting opportunities, except in the banking sector.
Okay, let's talk buying opportunities, and then we'll get back to the banking sector. Where do you see buying opportunities?
I mean, I think there's some infrastructure companies that are coming in. You know, the money that the government is going to be spending has just been a trickle this year. It's really going to come in starting next year. I mean, if you speak to the companies, they'll all say it's really not having any impact on our earnings yet, but a lot of plans are being drawn up. You know, I expect 2024 and 2025 to be massive years for infrastructure type companies.
So I know you can't talk individual stocks, but infrastructure at large.
Yes, I mean, aggregates, road building, factory building, automation. Eventually, someday, solar will come back. You know, kind of in that whole area, reshoring, greenification, et cetera.
You like bonds at all? Short, long, muni, corporate?
I don't short anymore. I'm not short bonds. I find.
No, I mean short duration, long duration. What would you buy?
I like relatively short duration.
5 year?
Nothing more than 5 years.
5 year corporates or treasuries or munis? Or
I like, you know, for some of our clients that have cash, we've bought some, call it 5 year duration corporate bonds.
What quality? Like
high quality.
High quality.
And
what can you get there?
Over 5.
Over 5.
But the interesting thing is that you can get over 5 just for buying a 3-month treasury, and even in our money market fund,
3 months from now,
you
might not.
But it might not. So you're taking risks there. But you know, a combination of the two is if in a client's account or some variation thereof. At this point, for those who have cash, I think is a good thing to sit and wait in that stuff.
the very thing that makes you positive about some of these infrastructure plays, the idea that a lot more government spending is going to really kick in, could that just hurt in terms of inflation, just the continued spending that comes through?
We'll see. Like I said, I'm not an economist. We'll see what happens. I doubt it, but I don't have any evidence at this point.
What else do you like?
Well, I don't like banks, that's for sure.
Okay, what about banks? Is it the underlying credit issues?
It's not so much the credit issues.
Okay, then it's the regulatory
I actually think,
structure?
if I could be somewhat blunt, not from a trading perspective. I mean, if you want to buy Morgan Stanley and Goldman Sachs because you think investment banking is going to come back a little bit and it's a trade, fine. I happen to think the whole banking sector is uninvestable.
Why?
One, even though deposits are down year over year around 6%, that's mostly concentrated in the medium to small cap banks. The deposits in the banking industry are still $2 trillion above trend. It's still going to come out. You know, if rates go higher, it's going to come out faster. So the idea that net interest margins are going to bottom anytime soon, I just think is wrong. The other thing is that the new regulations that have come out increase the amount of capital that the banks have, which I actually think is the wrong thing that the regulators are doing, which is something that Jamie Dimon has said recently, but it's going to hurt the earnings and return on equities of the banks. Unfortunately, I don't think any of the CEOs, including Jamie Dimon, have any credibility with respect to regulation, with respect to the regulators.
Why?
Which is unfortunate. You know, if you go back to after Dodd-Frank, the first vice chair of financial supervision, which is just a fancy term of saying bank regulators, was Daniel Tarullo.
Yeah.
He's on today.
What's that? Oh, is he really?
Yeah.
So I'm going to give a big compliment for him to be on today, which you could.
Maybe we'll cut a sound bite.
Well, the sound bite is that he's the greatest banking regulator in the history of the United States, and no one's even a close second.